The US bond market began expressing concerns over the looming fiscal cliff in tandem with equity markets, and that was shortly after the re-election of President Barack Obama. But instead of yields on the US 10-year treasuries widening, they have in fact compressed, falling from 1.70% to 1.60%. To explain why this is not good news, we're joined in studio by Ian Scott from Stanlib. Well, Ian, thanks so much for your time. You know the question, why is this not good news in terms of falling US bond yields?
Well, it's a good thing for bond markets. We like it. But obviously there's a concern of bond markets. How does the whole fiscal cliff unwind? You know, what is going to be the main structure? Because if the fiscal cliff is not negotiated well, there's a big risk that the US can go into recession in early 2013, and I think that's what's bad.
When we talk about this fiscal cliff, we're talking about tax increases, spending cuts. So that's the bottom line.
That is the bottom line. Is about $600 billion. So it's big. It's major on the US. And if that doesn't get extended, there's a probability that the US can probably go into a recession of about 1.5% negative growth next year, which is very concerning for bond markets and obviously global markets.
And that's the number. I mean, we've heard this number as high as a possible 4% effect on GDP in the US. I mean, is there real research and analysis behind that number, or is that just something that has been trumpeted around in the marketplace at this point? I mean, are we really talking about the US economy going backwards by 4% if the Democrats and the Republicans can't put a deal together?
I don't know about the 4% number, but good research that we've probably seen is probably negative 1.5%. So maybe 4% is a little bit much, but it's definitely recessionary. But hopefully, I think the markets think that it will be resolved. It's going to be what they call kick the can down the road. So I think there will be a negotiated settlement, but it will probably be extended to somewhere later in 2013 or 14. So.
But one day we have to face the music.
Well, we all have to face the music one day. The problem is we're using our children's money, and that's the problem, and that's what's going to happen. What is down the future? But that's maybe the good story. That's why somebody like Mr. Bernanke came out and said, well, you know, the Fed is not going to take away the accommodative monetary policy before 2015, and all likely it might even be longer if this fiscal cliff just continues rolling into the future.
Yeah, and this is an interesting scenario because obviously we've seen what happened in Europe with Spain, Portugal. The bond yields rose there. They rose over 7% to the point where above 7% it was panic stations because everyone knew that they couldn't afford the debt at that level. Here we're talking about bond yields compressing. Just explain that to us. Why have bond yields moved in the opposite way that we would have imagined if the fiscal position was going to deteriorate in the US?
Just remember, Europe was a solvency issue. So bond yields rose because there was a risk of default that, you know, the Spanish government could physically not repay those debt. That's why the yields rose. In the US, it's because there's growth concerns. We all know that if there's growth concerns or there's going to be a recession in US next year, it's good for bond yields, it's bad for the equity market, and that's why bonds basically compressed because you probably saw that investors probably sold their more risky assets like equities and probably went into the bond market. It's quite interesting that somebody like Bill Gross came out this week from PIMCO, biggest bond fund in the world, and he said, well, you know, he always disliked US Treasuries in a big way, and he came out and said, I'd like to add 5% to my portfolio of US Treasury. So even a big fund manager like PIMCO is saying, well, we like the Treasury market, so it shows that there is concern around this.
Do you like the Treasury market?
Well, I think global bonds are expensive in developed markets, but I like emerging market bonds. We still think because there's this hunt for yield in the world, we are definitely very bullish on emerging market bonds. We like the bond market. We think there's good returns to be had, but developed market bonds are very expensive, so we'd like to stay away from that.
So just in terms of getting this right, what you're saying at the moment, we talked about this yield compression in the introduction here, going from 1.7 to about 1.6%. You're saying that investors are so worried about this at the moment, they're taking money out of the growth assets in the equity market and they're putting them into the safe haven of US treasuries or US 10-year bonds. Is that effectively what's happening? Is the market's almost reacting to the fiscal cliff before this situation's actually developed?
Well, markets always preempt, and the bond market is a smart market. So as soon as there's a what we call the risk-off trade, you'll probably see assets being liquidated from the more risky assets, maybe properties, equities, and probably going into the more, call it safe haven assets of US Treasuries. That's probably more liquid, got some sort of government guarantee on it. So that's definitely the trade at the moment. We've also seen it in the currency markets where, you know, the dollar is also strengthening against the euro. So it's definitely assets being repatriated out of more risky assets back into the Treasury market, no doubt, because suddenly, I mean, the dollar is probably trading sub 127 against the euro at the moment.
We've seen the accommodative monetary policy from Ben Bernanke already. There's talk that he might be increasing that. To borrow a term from the NFL in the States, he's actually running interference in the bond yields, because without the activity of the Federal Reserve in the States, what do you think that US 10-year bond yields would actually be? I mean, what would the normal rate be without this?
So they're being
massive
artificially propped up, in other words.
No, absolutely. If we were in a normal situation, you'd probably find that US bond yield would probably be close to 3%. So yes, the Fed is actively managing what we call Operation Twist, probably selling shorter dated bonds and buying longer dated bonds. But why? Because it's so important for the US housing market. What we call they're basically flattening the yield curve to support Freddie and Fannie, the housing mortgage originators, and that's what you need to do, because Mr. Bernanke saw that in QE1 it doesn't always help just pushing money into the market. You've got to flatten the yield curve to support the housing market, because that's still where the problem in the US is unemployment and housing. We've seen better data lately out of housing, but it's still a problem. It's a big problem. So the Fed is actually trying to, let's call it, put a floor under the housing market.
Do you anticipate that they will increase the level of quantitative easing and bond repurchasing that they're doing at the moment? I think moving from $40 billion to potentially $60 to $80 billion per month.
He's not called Helicopter Ben for nothing.
I've got no doubt. I think Mr. Bernanke will throw every tool in his disposal at the problem. We've seen him do it since 2008, so I would say why not? I think
more of the same. Expect more of the same going forward. Let's turn our attention to the domestic environment, and if you can give us your assessment of the level of foreign buying following our inclusion in the WIGBY, obviously a major event for the South African bond market.
So it is a major event. So into the run-up, we probably saw closer to 70 to 80 billion of bonds being bought, and after the inclusion it has been a little bit slower. Let's be fair, there's been some political events that's been happening in the country. We're not helping ourselves, but we have seen continued buying. But it's a global story. If you look at most emerging markets, we've seen inflows into basically on a day-to-day basis. So it really is a global story. What we have seen, what is much more important, is in previous years, what we call soft hands or weak hands, typically hedge funds and fast type investors have been buyers of South African bonds. What we've seen this year is typically long-term structural investors entering our market, which is quite important. Typically somebody like the California Teachers Pension Fund or the Danish National Pension, or long-term structural investors entering our market, and that's important. So everybody says, well, if there's a sell-off in South Africa, will everybody just run away? No, I don't think so, because structural investors don't just run away. They are long-term investors, and they like this 7 to 8% yield that they get in the South African market, because we're probably the only country in the WIGBY index that's probably got an 8% yield with our rating. So we look attractive. Let's be fair. South Africa's bond yields are attractive globally because global bond yields are so low.
So this is quite important. I didn't realize that you're talking about a composition change in the type of investor that's entering the bond market. And what you're implying is, as far as I understand it, is that it's going to be more moderate on the effect on the currency if they change their portfolios. It's not the hot money that's going to exit very quickly and create those big moves in the rand. Is that effectively what you're saying?
That's correct. Look, there'll always be volatility in the rand. There'll always be hedge funds in the bond market, and they'll probably get out if they don't like it. But the long-term structural money will stay, and we like that story.
Is that a direct result of inclusion in the WIGBY?
Yes.
That the profile of foreign investors changing?
It is, but it's also a long-term structural story, because South Africa we've got a deep liquid bond market, a swap market, and a liquid currency market. So those are three major important drivers for long-term structural investors, because hot money investors will come in and out quickly and test the market, but it will take a long while for structural investors to get into the market. And I think, let's say over the last 3 years, we've seen net buyers of bonds, and it always takes structural investors long-term to invest into the bond market. They just first want to test the water, and I think for the last 2 years, the fast money has tested the water, and this year we've really seen a big flow from the structural type of investors coming into the bond market. Yeah,
and we talk about this hunt for yield globally, and this tremendous push out of the developed markets to find yield around the world. Our local bond market's one of them. And we specifically with the WIGBY, we're talking about the government bond index. You pointed to, in your notes, you pointed to Sasol's recent bond issuance and how well priced, for want of a better word, that was relative to the US 10-year bond yields. Are we seeing the yield compression in the sort of high-grade corporate space moving lower as well because of this search for yield?
No, absolutely, because the hunt for yield is definitely on. The good quality corporates that's proven themselves, they are big in demand. So typically for Sasol, if they had to come to the market maybe 3, 4, 5 years ago, I don't know if they would be able to issue a 10-year bond, they would probably paid, I don't know, 400 or 500 points maybe over US Treasuries. Going sub 300 last week, they issued $1 billion. It's big. Yeah, I think it's well done. It shows you the good corporates can issue.
And you were saying earlier that you favour the South African or emerging bond market, or markets rather. Just in terms of the South African bond market, do you make a distinction between government bonds and corporate bonds, and which do you favour?
Oh, absolutely. Most portfolios will have a bit of both, just the way the regulations work, but we like corporate bonds, we like South African bonds as well, but there's a yield pickup in corporate bonds, because we think corporate bonds are actually in a very niche position at the moment. We know that corporate balance sheets are actually very lazy. They sit on all-time highs in cash, so you're actually buying very good quality companies at the moment.
So you've got more appetite for corporate bonds over government?
Well, depends on
in South Africa.
In South Africa at the moment, depends on the type of mandate. Probably in total holding, we'll probably hold more government bonds, but at the moment we are definite big buyers of corporate bonds.
We've got time for another question.
We do. We've got a couple more minutes.
Okay, great. Ian, we've a lot being said about unsecured lending in South Africa, and I wanted to understand the translation into the credit markets in South Africa. You buy government bonds, you buy a range of credit issued by corporates, etc. What are you seeing in terms of some of these unsecured lenders? Have they been borrowing a lot of money in the South African bond market?
Well, we have. Without mentioning names, I think all the names that you can think of have been big borrowers in the markets. Why? Because we think the bond market is quite attractively priced for these lenders, because you know, they can get very attractive pricing. They can borrow in term, where if they had to go probably to a bank type market or interbank type market, it could be a lot more expensive. It makes us very bullish on what's going to happen in the future with the bond market, that we think the bond markets will become very attractive in the future for corporates to borrow with the pending legislation around Basel III. So we're very, very bullish on what's going to happen into the corporate space, into the whole bond market. To all the issues that we've spoken to over the last while, not one of them has said that they're not going to increase their capital market issuance over the next few years, because they find that their banking lines are becoming much more expensive due to the Basel III pricing. There's a lot more opportunities in the capital market, so we like that space.
So outside of the banking and finance type companies, the micro lenders and what have you, are you expecting more activity, more issuance in the corporate bond market in South Africa?
No, absolutely. I think it's going to change phenomenally with the Basel III world, because you probably find once these massive cash balances in the corporate balance sheets has probably been eroded, the corporates will probably find that the banking system is going to be closed to them, it's going to be very expensive, and then the capital markets will probably be a lot more cheaper to finance in term than in the traditional banking system. And we're seeing it already with the charges that banks are placing on corporates in terms of facilities and term funding. We think there's lots of opportunity in the capital markets for funding for corporates.